A bond is a loan to a government or a corporation. So you are providing a loan to some organization in exchange for payments. And these payments are called coupons. And essentially you get coupons either monthly, quarterly, semi-annually, or annually. There may be some other different variations on that, but those are the normal standard time frames. What happens is the organization will set a price for a bond at either, typically it's $100 or $1,000, that's the par value of the bond. And then what they do is they pay a fixed percentage of that every period as a coupon payment, which is what I mentioned earlier. You can trade these, so you can buy and sell most of these bonds on the market, on the open market. Some you can't. Some you actually have to buy directly from the organization. Sometimes government bonds, you have to do that. You have to buy directly, let's say Ontario government bonds or Canada government bonds. You have to buy them directly, but for the most part, you can actually trade them. And so what that means is that they have a price that fluctuates. That price can be affected by a ton of things, and the coupon, the rate that you get paid, also is affected by a ton of things. So I just want to go really quickly into those. Bonds are typically considered low-risk investments. In fact, government bonds are considered in the finance world to be risk-free, which essentially means that the government's backing it up, so it'll get paid almost no matter what. Now, what can affect, so what happens is then government bonds are actually the lowest paying bonds. They'll have the lowest interest rate. And what can affect these bonds, what can affect the interest rate that bonds pay, are a bunch of factors. So first of all, the credit rating of whatever organization issues it. So if it's a higher risk organization, it has a worse credit rating. And as a result, it has to pay a higher interest rate. If you think about it, it's similar to when we go to a bank to take out a loan. If your credit rating is lower, the bank will give you a higher interest rate. It'll force you to take a higher interest rate in order to lend you money. It's the same way with bonds and organizations. The other thing that can affect it is actually interest rates in the broader economy. So when you have the government, central banks, let's say, setting interest rates, those will affect the rates that are paid on bonds. And I should say that it doesn't affect bonds that are already issued. It will affect newly issued bonds. One other thing I do want to mention is that prices of bonds, and this is good, so now I'm getting a little bit deep into this, but prices of bonds are inversely related to interest rates. So what happens is when interest rates go up, the price of a bond goes down. And the reason for that is if general interest rates become higher than the amount you would earn on the bond, so let's say I buy a bond that pays 2%, right? 2% annually. If interest rates at a bank are 3%, that means there's no reason for me to buy the bond. I'll just go to the bank, I'll give them my money, I'll make 3% instead of buying the bond and making 2%. So the price of the bond falls to make up the difference, right? So it's selling for less than it was actually issued at. And so and then that resulting difference becomes your sort of 1% that adds on to that.